The leveraged buyout of a grand hotel follows a predictable playbook whose steps are documented, with varying degrees of completeness, across multiple case files in this channel's archive. Step 1. A private equity firm identifies a hotel whose brand recognition and institutional significance have produced a market valuation that the hotel's current operating performance does not justify, a premium above the property's financial fundamentals whose source is the hotel's cultural and historical authority rather than its cash flow generation. Step 2. The firm acquires the hotel using a debt structure whose service requirements are calibrated to the operating performance that the hotel would generate if it were managed at the efficiency levels that the private equity model considers achievable through cost reduction, revenue optimization, and capital structure improvement. Step 3. The firm implements the operational changes required by the debt service obligation, reduction in staffing levels, deferral of capital investment in guest-facing amenities, renegotiation of vendor contracts, and the systematic extraction of cost from operations in ways whose short-term income impact improves the debt service coverage ratio while their long-term competitive impact degrades the hotel's market position. Step 4. The hotel's competitive position declines as the cost reduction program reduces the service quality and physical standard that the hotel's brand premium requires. Revenue per available room growth decelerates or reverses. The debt service coverage ratio deteriorates. Covenant breach follows. Step 5. The private equity firm's holding period concludes in one of three ways: a sale to a new owner at a price reflecting the hotel's degraded operating performance and the market's discount for the required renovation investment, a bankruptcy filing that transfers ownership to the lenders at the lender's recovery value, or a restructuring that modifies the debt terms at a cost to the lenders that partially or fully recovers the firm's equity. This is not a description of a specific hotel bankruptcy. It is a description of the private equity leveraged buyout playbook applied to the category of hotel assets that this channel has called grand hotels, irreplaceable properties, whose value is substantially rooted in institutional significance rather than financial performance. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure. The specific characteristic of grand hotels that makes them particularly vulnerable to the private equity leveraged buyout playbook is the gap between the institutional premium their market valuation reflects and the financial performance their operating model can generate. A grand hotel's institutional significance, its history, its cultural authority, its position in the civic life of its city, commands a premium above comparable hotels whose source is non-financial. The premium is real. Buyers consistently pay more for the Ritz Paris, the Roosevelt New Orleans, or the Helmsley Palace than for hotels of equivalent physical quality and equivalent financial performance. Because the institutional significance adds value that conventional hospitality appraisal methodology struggles to quantify, but that the market consistently prices, the private equity acquirer interprets that premium as an opportunity rather than as a constraint. The opportunity interpretation treats the institutional premium as the difference between the acquisition price and the underlying financial value, a gap that the leveraged buyout's operational improvements will close by improving the financial value to match the acquisition price. The constraint interpretation treats the institutional premium as the condition for the hotel's maintenance of its market position. The premium is sustainable only if the service quality, the physical standard, and the staff investment that produce the institutional significance are maintained at the level that the premium reflects. The covenant that private equity acquirers consistently fail to read carefully enough is the one embedded in the constraint interpretation, that the premium is not a financial artifact available for extraction, but the condition for the hotel's competitive positioning that the acquisition price assumes will be maintained. When the leveraged buyout's operational changes extract value from the hotel's service quality and physical standard, they do not close the gap between the acquisition price and the financial value by improving the financial value. They close the gap by reducing the institutional significance, eliminating the premium, and leaving the hotel with a degraded competitive position and a debt structure whose origination assumed the premium's maintenance. The private equity playbook works in categories of assets where the institutional premium is separable from the operational performance. In grand hotels, it is not. At what point does the application of a standardized private equity operational model to an institutionally significant asset constitute a fundamental misreading of what the asset is? Leave your analysis in the comments below. The appraisal methodology that supports the private equity leveraged buyout of a grand hotel shares the foundational error this channel has documented across its archive, but expresses it through the specific dynamic of institutional premium valuation applied to a leveraged acquisition thesis. The origination appraisal for a grand hotel leverage buyout must simultaneously justify the acquisition price, which reflects the institutional premium, and support the debt structure, which requires the hotel's stabilized operating performance to service the debt at the coverage ratio the lender requires. Those two requirements are in tension. If the acquisition price reflects the institutional premium, the hotel's stabilized operating performance as currently operated will not service the debt at the required coverage ratio, because the institutional premium exists precisely because the hotel's operating model prioritizes service quality and institutional maintenance over financial performance optimization. The appraisal resolves this tension through the pro forma, the projection of operating performance as it would be achieved if the hotel were managed at the efficiency levels the private equity operator considers achievable, rather than as it has been managed historically. The pro forma is not false. The private equity operator can often achieve the operating efficiency improvements the pro forma projects. The question is not whether the cost reductions are achievable, but whether the cost reductions are compatible with the maintenance of the institutional premium whose continuation the acquisition price assumes. The pro forma incorporates the cost reductions without quantifying their impact on the institutional premium, because the institutional premium is not a line item in a hotel income statement. It is the source of the revenue per available room premium that the hotel commands over its competitive set, and its erosion appears gradually in revenue per available room relative to the competitive set, rather than immediately in the operating statements where the cost reductions produce their income improvements. By the time the revenue per available room premium erosion is visible in the financial statements, the debt structure is in place, the operational changes have been implemented, and the covenant breach that documents the appraisal's failure is the only remaining measurement of the gap between the pro forma and the outcome. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. The case files in this channel's archive that most precisely document the private equity leveraged buyout playbook applied to grand hotels are the cases where the playbook's application produced the specific outcome. The playbook structure makes predictable. The Caesars Entertainment case, documented in Case File 018 and Case File 028, is the most precisely documented instance of the private equity leveraged buyout applied to a portfolio of gaming and hospitality assets whose institutional significance and brand premium the $30.7 billion acquisition price reflected, and whose subsequent operating performance the debt structure's service requirements made impossible to maintain at the level required for compliance. The Trump Taj Mahal case, documented in Case File 014, documents the application of a debt structure calibrated to Atlantic City gaming revenue projections whose optimism bias produced a covenant breach within 11 months of the casino's opening, before the institutional significance the debt structure assumed had been established. Through the operational track record, the stabilized performance projections required. The Helmsley Empire case, documented in Case File 046, documents the application of personal credibility as a substitute for operating cash flow in a hotel portfolio that the controlling figure's individual management style had optimized for institutional prestige rather than for the financial performance metrics that conventional hotel management efficiency models require. Each of these cases is an instance of the private equity leveraged buyout playbook's specific failure mode, the application of a debt structure calibrated to an operating performance projection that treats the institutional premium as a financial artifact available for extraction, rather than as a condition for the hotel's competitive positioning that the premium's continued existence requires to be maintained. The institutional denial distributed across the private equity leveraged buyout cases in this channel's archive is consistent. The belief, shared by the private equity operator, the lending institutions, and the rating agencies whose capital market participation enables the transaction, that the gap between the acquisition price and the hotel's financial fundamentals is a temporary condition resolvable through operational improvement rather than a permanent condition produced by the specific nature of the asset being acquired. Grand hotels are not temporary. Their institutional significance is not a temporary deviation from their financial fundamentals. It is their financial fundamental. The resolution of the private equity leveraged buyout of a grand hotel documents, with the precision that only a financial transaction's public record provides, the specific cost of misreading what a grand hotel is and what its value represents. The cost is measured in three ways simultaneously. The first is the financial measurement, the gap between the acquisition price and the recovery value at the resolution's conclusion, expressed as the loss the lenders absorb and the equity the private equity firm writes off. The second is the institutional measurement, the degradation of the hotel's competitive position and revenue per available room relative to its competitive set across the holding period, expressed as the share of the institutional premium that the operational changes eliminated and that the resolution's new ownership must restore through renovation, investment, and management commitment. The third is the civic measurement, the years during which the hotel's physical standard and service quality fell below the level that the institutional significance requires, expressed as the period during which the city whose civic life the hotel serves was deprived of the institutional presence that the hotel's premium implied. The Ritz Paris case, documented in Case File 052, is the standard against which the private equity leveraged buyout of a grand hotel should be measured, an owner whose time horizon and return expectations were compatible with the institutional maintenance that the hotel's premium requires, who invested in the hotel's physical standard at the level the premium demands, and who monetized the institutional significance through the renovation and brand enhancement that maintain the premium rather than through the cost extraction that eliminates it. The private equity leveraged buyout model is not inherently incompatible with hotel ownership. It is incompatible with the specific category of hotel whose value is substantially rooted in institutional significance, because the institutional significance is the source of the acquisition price's premium and the condition for the debt structure's service, and the operational changes required to service the debt eliminate the condition for the debt's sustainability. If this case file changed how you evaluate private equity's role in grand hotel ownership, subscribe because the next episode examines the specific application of this playbook to one of America's most architecturally significant hotels. And in the comments, given the documented incompatibility between private equity leveraged buyout models and institutionally significant hotel assets, what specific acquisition structure would most effectively preserve both the financial returns that private capital requires and the institutional significance that grand hotels represent? The case file is open. This content was developed using artificial intelligence tools as part of the research, writing, and production process. All AI-generated material was subject to human review, editorial intervention, and approval before publication. Factual claims, interpretive framing, creative direction, and final content decisions reflect human judgment throughout. This disclosure is provided in accordance with platform transparency standards for AI-assisted content.